Dennis, the rout in the global credit markets has many on Wall Street worried that the flow of leverage buyouts will start to slow or dry up. Are the jitters overblown? Is private equity concerned? And could the credit squeeze truly derail some of the big deals in the pipeline? Some thoughts from Dennis Berman of the Wall Street Journal. We also have James Poletti with the Financial Times, John Morris at The Deal, and Roger Aguinaldo, who is the publisher of M&A Advisor newsletter. Dennis, let me start with you because I hear a lot of people saying today that they think that some of these big deals that are already committed may not actually happen. I mean, I don't really understand that. These are very fully committed deals with very few outs. How is that possible?
That's a very good point. It would be reputation destroying if
disaster.
If a big bank said we can't step up for the financing, and the banks have become so big that even though they see these numbers seem...
Wait. What do you mean they can't step up to the financing? I mean, they have underwritten these deals. It just means they have the paper stuck on their books for a period of time. They don't really have the option. They'd be in litigation forever.
That's the point I'm making. The fact that they're so big as institutions means that even though the dollar figures seem large to us, they are still somewhat small to the overall balance sheet. So I find existing deals falling apart a difficult scenario. The real question is future deals, big deals coming apart. Right now, it looks like the market is closed. So another 20, 25 billion, $30 billion LBO, I don't think we're going to see another one of those for quite some time.
John, how severe do you think it is? I mean, it seems like we're going to stop hearing phrases like pick toggle and covenant light deals for quite some time. Or no? Is that a dramatization?
No, I think that's right. That what's happening in the markets right now has strengthened the hands of lenders and investors in this paper. So the covenant light deals, these very loose lending arrangements where the borrowers are under very few restrictions. I think we're going to see that those evaporate pretty quickly.
James, what do you think? I mean, the buyers can't really walk away here. The reverse breakup fees are enormous. In a deal like Altel, I mean, we're probably looking at something like, I mean, I don't know, I haven't seen it, but it's got to be something like $500 million if they walk away.
Well, certainly the buyers would have a lot of trouble walking away. And also, as Dennis mentioned, the reputational risk would be huge if a buyer were to walk away. I think they're going to be stuck with it. And I think the big hope among the private equity executives at the moment is that once this glut of financing gets through the market, at some point later this summer, that things will stabilize and that they'll be able to slowly move back to doing some of their large transactions.
Roger, how about you? Do you think the fear that one of these huge deals is going to not happen is largely unfounded at this point, or do you think one of them could blow up?
Well, actually, I have to disagree with my fellow panelists here. KKR has about $122 billion of deals in their pipeline. If on any of those deals that they can't raise the financing for, I mean, don't you think that all of the other deals based on each individual merit? What
are you talking about there when you say they can't raise the financing for? I mean, if they're already underwritten, they're already underwritten.
Well, I mean, what happens basically with private equity firms is they're in a return game. If they can't get the return on any of their investments, if a deal blows up, what's going to happen is they're going to have problems raising their own, raising money in the future, raising additional money. KKR is in the midst of going public. KKR has a lot of deals in their pipeline. They got a lot on their plate. If any one of those deals goes sour, or something wrong happen with it, it's going to affect a lot of deals, not only KKR's, but a lot of private equity deals.
Melissa, there's something worse than a bad return on a deal. That's having to go back to your own investors, asking them for $500, $800 million to fund a breakup fee. And for that reason, firms like KKR will fight tooth and nail to get a deal done. And that's why I think it'd be very hard to see a scenario. Of course, it's possible, but at least hard right now for a firm like KKR to say we're not going to do a deal.
They're just going to hold their underwriters' feet to the fire and say, look, I'm sorry, it's too bad. You know, you're going to have this paper on the books for a while. You're not going to make as much money as you thought, but there's no way you're getting out of it. And, you know, we'll throw you the next 10 deals. You're going to make money down the line. You've made it off us before, right?
Sure. I mean, the big question here is how is this all going to affect the relationship between the private equity groups and the banks, which have been funding and helping fuel this leverage buyout boom of the last few years. And if relations turn really sour between the banks and the private equity groups, that could affect the sale of IPOs and all sorts of things in the market. So.
And if you take one step back, Melissa, Wall Street earnings have been so incredible in part because of the private equity deals. So you could say if they have to take loans now or take a cut on some of the paper, hey, that's the cost of doing business. They made a heck of a lot of money over the last 5 years.
Yeah,
so.
but John, it does mean that down the line, we are going to see that they're not going to want to underwrite as many deals in the near term. I mean, it's just going to be a little bit tougher to get financing at the very least. So we will see the amount of stuff that flows into the pipeline slow down, right?
I think absolutely. And, we had deals announced this week, but the financing commitments from the banks for those, date back several weeks. And I think what's going to happen is where the financings were about to, the commitments were about to be issued last week or this week, I think those are the ones that are going to be likely to be dead in the water. And as Dennis said at the beginning, I think it's very unlikely you're going to see, $25 billion buyouts announced over the next couple of weeks because the market has to settle down. There's this huge imbalance between the $225 billion of leveraged debt that's in the pipeline and the buyers. The issuance of CDOs has dropped off a cliff this month.
Yeah.
And the market's got to sort that out, figure out what interest rates are going to apply to these loans. It's going to have to settle down before more commitments are going to be written.
Yeah. Roger, I'll give you the last word. Do you agree with that?
Yeah, well, what's going to happen is that there are other private equity firms waiting in the hopper. There's the strategic acquirers who we're not really talking about. They're going to come back into the game. So, yes, we may see a slowdown with some private equity deals, but I think the strategic acquirers and the corporations are going to get right back into this market when the valuations come down a little bit better.
That's a great point. Let's end on that. All right, gentlemen, thanks so much for joining us.
Thank you.